This week's video is entitled Big Picture, Little Picture, and we're going to talk about how easy it is for investors to get the two confused as to where they should be focused. So I've been reading this Fred and Ted book series to my 4-year-old daughter every night before to bed, and one of her favorite of the stories is about Fred and Ted who've been out skiing and skating and doing all sorts of stuff, and they head into the little motel, and Fred the big dog gets a little bed, and Ted the little dog gets a big bed, and they can't sleep. You know, the beds are not right for either one of them. They wake up feeling exhausted. Well, after a morning walk, they realize that they should be switching beds. The big dogs need big beds and little dogs need little beds. How is this relevant to investing? Always love to try and find a parallel. To me, it's this. Are you using the right mind frame? Are you using that big picture mind frame at the right times? And are you focusing on the little picture when you need to be focusing on the little picture? This week, we're going to talk about why you need to be focusing on the big picture with respect to markets and using the little picture with respect to your portfolio, but how easy it is to get the two confused. So let's start with the markets. Here's an area where people tend to look at the little picture. They're looking at the day-to-day movements. They're looking at quarter over quarter. They're even looking at year over year when they really need to be looking at the big picture. Why is this? It's because those averages that we all seek and that so many of our plans are built around and that we're counting on only show up over long periods of time. For those of you who've been watching these videos for some time, you've heard me cite some of these statistics before, but they're worth repeating. Half of trading days are negative. A third of months are negative. 1/4 of years are negative. And so there's a lot of chances to feel at any given point in time, if we're looking at the little picture, that it's not working. When in fact, you'll get that long-term return if you give it enough time. That being said, how much time is enough time? Well, if we look back over the last 93, 94 years in the stock market, it's averaged right around 9% US stock market. And yet in no single calendar year have you had a return of between even 7 and 10%. So as people are checking in, and of course you want to be diligent and prudent in monitoring it, and you should be, but looking too tight at that little picture as opposed to really stepping back, looking at that 3-year, that 5-year, that even 10-year average might give you the sense that something's awry when you're perfectly fine and you're on track. Time frames, as we've been talking about a lot, can be so confusing. And there's so many things that try to get you off big picture, little picture type things. I'll talk about two that were making the rounds this week. One was the put-call ratio. So you might be hearing whether it's SoftBank investing in stocks, the amount of option activity that is setting new records every day. And these things tend to be indicative of periods of speculation right before often a market correction. Little picture. If we step back just a little bit and look at something called the breadth thrust. So we got spikes and thrusts going on this week. The breadth thrust looks at situations, and there have only been 29 occurrences since the 30s, where there's a 2-to-1 advance, 2 stocks going up for every one that's going down in the market. And if you look at those occurrences, 96% of the time, over 12 months, the market is higher 12 months later. So again, time frames, big pictures, little pictures, of course, most importantly, what is most relevant to you. So the second piece we're going to focus on within this big picture, little picture theme is your portfolio. So unlike markets where people tend to look at the little picture when they need to be focusing on the big long-term picture, with portfolios, it's often just the reverse. People are focusing on the big picture, i.e., portfolio balance, myopically looking at it, is it going up, is it going down, when they really ought to be evaluating all the little pictures that make up their portfolio. As we've talked about here, and we very well may reuse the series from a couple years ago around the whys around your portfolio, but each little piece within most people's diversified portfolio is there for a specific reason. Some are there for growth and inflation protection to help grow those assets over time, and they certainly need to be participating when risk markets are doing well. Other pieces are there for preservation and income and to help give you some security when things aren't going so well. The problem with looking at the big picture from a portfolio perspective too often, or to the exclusivity of everything else, is it might mask a lot of what's going on underneath. When you look at those little pieces, your risk assets are doing just fine in a year like this, amazingly. But here again, maybe your portfolio value's down during a bad market, but some of the pieces that are there for your protection, for your income stream, are holding up just fine. So again, within that portfolio perspective, that's the time to get myopic, look at those individual pieces, ask, what are each of these pieces here for? What are they supposed to be doing? When should they be thriving? When might they be struggling? And are they doing what they should be doing given the environment that we're in? Are they meeting the objectives that you need for your plan? With that, just like Fred and Ted, finding the right bed, make sure you're finding the right mindset as you're evaluating the market as a whole, as you're evaluating your portfolio. I think if you do it just like the good night's sleep that Fred and Ted found in that book, you too will find a good night's rest with respect to your financial life. Thanks so much.